Welcome to a new series of videos where the intent here is just to focus on a few things that are happening in the market right now. I have a couple of charts to show you and also an opportunity to tell you about the program that I have. So yes, this is promotional. Hopefully you'll find this educational at the same time. In this particular video, we're asking the question, is the S&P 500 getting ready to fall apart? And this is being recorded for Monday, June 2nd. The first chart that I want to show to you shows the S&P 500 on top and how we were coming up out of 2020 into 2021, and then we went into that bear market in 2022. We finally found a bottom in late 2022, and we've been going up ever since then. Then as we get into 2025, because of the tariff news and trade wars and uncertainty surrounding the economy, the market really started to take a dive in late March into April. We finally bottomed in April and we've been bouncing up ever since then. And lately we've been just consolidating sideways. One area that we can look at are a number of different studies. The study that you see down below is the SPY, which is the ETF for the S&P 500. Very liquid, highly traded, very popular. It's the foundation of all of the strategies that I implement and that I teach in the program. We can do a ratio with that against the staples sector. Now, staples are considered to be more defensive. If you are a money manager and you have to be invested all the time in the market and you're afraid that the market's really going to start going down, you might get out of growth stocks like Nvidia, Microsoft, Apple, and switch over to what are called staples. And think of toilet paper and toothpaste. The things that people have to have no matter what's going on in the economy. It's not that staples won't be under pressure during this period of time if we're actually getting more defensive. It's that they'll go down less than some of the growth areas. It's really nice when the market's going up and we can get into growth stocks and they really increase in value. The market doesn't always go up. There are times when it consolidates or actually declines. That's when we see a shift over to staples. Now, what we do here is we look at a ratio between the S&P 500 itself, represented here by the SPY, and the staples sector. What we saw at the end of 2021 was everything was going up and looking pretty good there. Well, then we started to roll over in late 2021, and then we started to come down with this ratio. We actually dropped below this rainbow. We kept going down here. When this is going up, that means the SPY or the S&P 500 is outperforming staples. It's more offensive at that point. When this starts to come down, that means the S&P is underperforming the staple sector and the market's being more defensive. And you can see that represented by price action. We were going up nicely into the end of 2021, and then we really started coming down. We saw this ratio also going down at the same time. Then when we finally hit a bottom, we saw this ratio start to come up above the rainbow, showing here that the S&P was outperforming the staple sector, and we had some pullbacks along the way. But for the most part, this has been pretty positive. What we're focusing on now is over on the right-hand side. Not as clean as what we were seeing at the end of 2021. This was just a real rollover. And if you notice here, where we topped out with this ratio at the end of 2021, we didn't top out with the S&P 500 until the beginning of 2022. So watching this ratio gave us a little bit of a heads up. As things were getting more defensive in March and into April, we saw this ratio really coming down. Then we finally bottomed. And now we've been coming back up here and we're improving, but we still want to keep an eye on this ratio. If we see more weakness as we're heading into the summer months, this ratio could end up coming down and give us some insight as to what will ultimately happen with the S&P 500 itself. Another chart just to show you is called Fibonacci retracement lines. And this is a way of using mathematics to try to determine how far is the market likely to retrace. And with this Fibonacci chart, there's a low set at the October 2022 low, and then we came up out of that. And then we set the high in February of 2025. We measure from the bottom to the top, and then that creates these Fibonacci retracement levels. These can be very useful, not only because it gives us some insight as to market psychology and what's going on with people's feelings. There are millions of people who are watching this chart and making decisions using the same information that you see right here. As we were coming down in March and into April, we came right down to the 50% retracement level. And we just hit that spot on, and so far we've been able to bounce back above that. We regained the 38.2% retracement level, and currently we're above it. And I call this no man's land right now. This chart won't be redrawn until we actually go back and set a new all-time high, if or even when that will ultimately happen. But this can be another tool that we can use. And the nice thing about this is these lines are on the chart before price even gets there. So as we were coming down in March and into April, this 50% line was already here and came down, and then we were able to bounce up off of that with some good solid strength and a real pickup in volume. And so this gives us some insight to things that we can see ahead of time. So what are some conclusions that we can draw from this? One chart, or two charts in this case, should not be used to reach a conclusion. You will find that people will post videos on YouTube or on Rumble and they'll put everything into one chart. I don't do that. There's always something else that we need to take into account. Now, you may disagree with that, and that's fine. Some folks say, well, what you show in your videos is just analysis paralysis. No, I have a whole different approach that I use for that. What I implement in a thing called the SPX Investing program is a thing called the consensus approach. We don't use just one or two charts to tell us what's going on. One or two charts may be really telling us something, and we may tend to look at those a little bit more, but we take all the information together and try to use a consensus. Another way that you could describe this would be the weight of the evidence. What's the evidence suggesting right now? Are we more positive? Are we negative? Because it's never black and white. It's always gray. There's going to be some positive things and negative things happening all at the same time. In fact, when everything lines up and looks positive, that's usually when we're at a top. Just like when everything lines up and we're looking negative, that usually means we're at a bottom. But your emotions and your intuition is going to be telling you just the opposite at that time. And so over the years, I've developed this approach called the consensus approach, which has been very helpful. Because I have found out over the course of time that what you don't know can kill you. There's always something happening in some market, whether it's a news event or something happening in the bond market or oil or something like that that can really come in from left field and seem to catch folks off guard. If this is interesting to you, feel free to check out the full program that I have. There's a link that will be below this particular video that will take you to the site. And to give you a little bit of information about the program, I have courses there, I have videos there, I have trade ideas that I post every day. There is an opportunity for group discussion about things, plus one-on-one coaching with me. There are also newsletters that I post and podcasts. Now, everything is free for right now, but you do have to go and sign up. Once everything finally gets kicked into gear here, it will be $97 a month, and even if you come in later down the road, there'll be a 30-day trial. Here is the link right here. Again, I'll post this below the video. If you're not interested in that, you like the daily videos that I do, and they're pretty long. They're long form because I'm using the weight of the evidence or the consensus approach to reach a conclusion every day. And some people have really found those videos helpful. But you're not interested in the courses, you just like the daily videos that I do, there is a YouTube membership that you can join, and that is $19 per month. If you're not interested in any of those, I do put out a daily newsletter, which is $8 per month, and that also comes with a 7-day free trial. That also includes a weekly newsletter that I put out. And then every day I also put out podcasts. I do a podcast every day. I do a weekly podcast, and those are available to you as well. And all of the promotional things are taken out of all the other videos. This is a promotional video. The other videos that I post are just for education and trying to give you insight as to what's happening. If none of those other areas are interesting to you, there is a free area of the website. It's at spxinvesting.substack.com. There are free blog articles that I post there. I try to post about one a week, and they're long form. They really go into detail. And there are videos that will be posted there, like this one, that will be made available to you that you can watch, and I take out all the promotional things in that particular video. You have a chance to be able to interact with me through that as well. So thank you. I hope you found this useful. If you have any questions, here's an email address where you can contact me, or please feel free to leave a comment. Have a great day, and I will talk to you in the next video.